Hi, I'm Andrew Drain and welcome to my November market update. And what an interesting market we are in at the moment. Australian housing values were 1.3% higher in November, marking the 14th consecutive month where CoreLogic's National Home Value Index recorded positive value growth. The November update takes national housing values 22.2% higher over the past 12 months, adding approximately $126,700 to the median value of an Australian home. Although values are continuing to rise, the November result was the softest outcome since January, when values rose 0.9%. Since a cyclical peak in the rate of growth in March, when housing values rose 2.8%, there has been a notable trend towards milder price growth. The slowdown in pace of growth is due to a number of reasons. Virtually every factor that has driven housing values higher has lost some potency over recent months. Fixed mortgage rates are rising higher, listings are taking some urgency away from buyers, affordability has become a more substantial barrier to entry, and credit is far less available. The capital city trends are showing great diversity, with Brisbane and Adelaide now recording the fastest pace of growth, while conditions across Sydney and Melbourne have slowed more sharply. Houses have continued to outperform units, with capital city values up 1.2% and 0.7% respectively over the month. However, the quarterly rate of growth is now the narrowest it has been since October last year, with 1.6 percentage points between the two broad housing types. Based on median values, capital city houses are now 37.9% more expensive than capital city units, the largest difference on record. In dollar value terms, a capital city house is averaging approximately $240,500 more than capital city unit. In Sydney, where the gap between house and unit values is at its widest, a house costs $523,000 more on average than a unit costs. Across regional Australia, the strongest growth trends remain skewed towards the coastal and lifestyle markets, with New South Wales, Southern Highlands and Shoalhaven recording the highest quarterly growth rate, 9.7%, followed by the Hunter Valley, excluding Newcastle, at 8.9%, and Tasmania's Launceston at Northeast region at 7.7%. Demand for housing across regional markets, especially those within commuting distance of the major cities, is continuing to benefit from the rise in popularity of remote working arrangements, along with renewed demand for coastal and lifestyle properties, and in many cases, more affordable housing options. A rise in the number of homes available for sale is a key factor driving the slowdown in capital growth. Nationally, the number of new listings added to the market over the 4 weeks ending November 28th was tracking 15.7% above the 5-year average, the highest level since late 2015. Fresh listings are being added to the market faster than they can be absorbed, pushing total active listings higher. More listings imply more choice and less urgency for buyers. Although inventory levels are rising, the upward trend is from an extremely low base. The total number of active listings has increased by 67.3% since early September, but stock levels remain 24% below the 5-year average for this time of the year. We expect inventory levels will continue to normalise into 2022, which will see selling dynamics gradually shift away from vendors, providing buyers with some additional leverage at the negotiation table. As listings rise, we are also seeing a subtle softening in vendor metrics, such as the median number of days it takes to sell a property and auction clearance rates as well. Capital city homes are showing a median time on market of 25 days, up compared with a recent low of just 21 days in May. At the same time, auction clearance rates have trended lower, with the capital city weighted average reducing from the low 80% range in early October to the low 70% range by late November. The rise in listings and softening of key vendor metrics implies the housing market may be moving through peak selling conditions. However, it will be important to see if this trend towards higher listings continues after the festive season, and we wait to see what happens there. The trend in rental growth has held reasonably firm since April, with a monthly change in national rents holding between 0.6 and 0.7%, well above the decade average monthly movement of 0.2%. Every capital city and rest of state region recorded a rise in dwelling rents over the month, with house rents generally continuing to record a faster rate of growth than units. Melbourne is one of the few exceptions where unit rents have risen at a faster pace than house rents over 4 of the past 5 months. Now, although rents are rising, gross rental yields have continued to reduce as housing values rise at a faster rate than rents. Nationally, gross rental yields fell to a new record low in November, reaching 3.23%. Gross rental yields reached a new record low across every capital city and broad rest of state region in November, implying a growing imbalance between the costs associated with owning a home versus renting a home. With mortgage rates also extremely low, such a small yield is overly concerning at the moment. However, as investment activity increases along with the growing potential for higher interest rates, we can see more investors once again relying on a negative gearing strategy over the medium to long term, highlighting the importance of negative gearing remaining in place. The outlook for Australian housing markets remains positive. However, the pace of capital gains has lost momentum across most regions since April, and we're seeing that trend here in the Hills. The trend towards slowing growth is likely to continue into next year and beyond. Most of the factors that have been pushing housing prices higher have either diminished or expired. Fixed-term mortgage rates are rising, which could act as a disincentive for some buyers. Although fixed rates are rising, variable mortgage rates are less inclined to rise until the cash rate lifts, which is still expected to be more than a year away. That depends who you talk to. Low mortgage rates will continue to support housing demand, but probably not to the same extent as seen through 2021. Housing affordability is becoming more challenging from month to month. The latest housing affordability metrics from CoreLogic and ANZ show the ratio of housing values to household incomes reached a new record high in June, as the number of years it takes to save a deposit increased, with higher barriers to entry, especially for new home buyers who don't have the benefit of accrued equity behind them. It's likely housing demand will be progressively impacted as fewer households can afford to buy. A natural consequence of worsening affordability could see demand increase for more affordable, higher density housing options such as townhouses and units. Tighter credit policies could also slow housing activity. APRA has already lifted the serviceability buffer for new lending by 50 basis points. While this policy isn't likely to have a material impact on home lending, APRA went on to release a macro-prudential policy framework in November, which calls out growth in asset prices along with other factors including credit growth and lending conditions as a key indicator of emerging systemic risks. The potential for higher credit policies in the future remains a downside risk for housing. Although the housing headwinds are building, a variety of tailwinds should continue to support the upward trajectory for home values in the short term. Although mortgage rates are rising, the cost of debt is likely to remain well below the long-term averages, continuing to support demand for an external period of time. Additionally, as more Australians are vaccinated, disruptions from COVID should become less frequent and shorter in duration, although the latest Omicron variant presents some additional risks. We don't know how that's going to play out. Open international borders, despite the recently announced delay, are also a net positive for housing markets, although the most immediate impact from resumed overseas migration will be seen in rental demand, not housing demand necessarily, while an uplift in purchasing a home from permanent migrants is likely to be more gradual. Well, that's my market wrap up for November 2021. A bit of uncertainty has crept into the housing market, ladies and gentlemen, but I think we all need to remember how resilient our market is and how important it is to the Australian economy as a whole. I'll see you in 2022 for a very exciting 2021 wrap up. I'm Andrew Drain. Have a great festive season. Merry Christmas. See you in 2022.